$850 billion is loud. Basel III is quiet. And that is exactly why it's dangerous. Because this story isn't a headline, it's a rulebook change. It's a line of text inside a banking regulation that quietly changes what paper gold costs to carry. And when the cost to carry goes up, the market doesn't politely adjust, it snaps. If you own gold, if you trade it, if you think spot price is the real price, I need you to slow down for a second and listen. Because the next shock in the gold market may not come from war or the Fed or inflation prints. It may come from Basel III plumbing, the kind of plumbing nobody checks until the house floods. By the end of this video, you'll understand three things clearly: what Basel III actually forces banks to do, why that targets the paper gold market more than the physical market, and the exact signals to watch so you're not reacting after the move. You're positioned before it. Let's start simple, because confusion is how people get trapped. The gold market is not one market. It's two markets living on top of each other. One is physical, bars, coins, allocated vault metal, refinery supply, jewelry, central bank reserves. The other is paper, unallocated accounts, forwards, swaps, futures, options, and some ETF structures, claims, promises, and IOUs that trade at enormous size because they're easy to move, easy to leverage, and usually settled in cash. Most of the time, these two layers behave like they're the same thing. A number prints on a screen, and everyone assumes it represents reality, but they are not the same thing. And Basel III matters because it is aimed at banks. Banks are the core plumbing for the paper layer. If the plumbing is forced to shrink, the paper layer can't pretend it has infinite capacity. Here's the timeline that matters. After the global financial crisis, regulators built Basel III to make banks less fragile, more capital, better liquidity, less hidden leverage. One part of Basel III is a rule called the Net Stable Funding Ratio, NSFR. In plain English, NSFR asks, are you funding long-term stuff with stable funding, or are you playing a rollover game that blows up in a crisis? The goal is boring and sensible, but the side effects in certain markets are explosive. Now, where does gold fit into this? Here's the key. Under NSFR, some assets require a lot of stable funding. Traded commodities can carry a high required stable funding factor. The Basel Committee's NSFR framework explicitly lists traded commodities, including gold, in a category that can require 85% stable funding. That number matters because it hits balance sheet like gravity. If a bank is warehousing a big gold-related position in a way that regulators treat as a traded commodity exposure, they are effectively saying, you need stable funding behind most of it. Stable funding is not free. It is not overnight money. It is not cheap rollover. It is the kind of funding banks fight over because it's scarce. And then the second piece, unallocated gold. Unallocated is basically a pool account. You have a claim, not specific bars with your name on them. It's convenient, and for decades it allowed the London market to operate like a high-speed clearing system for precious metals. But in regulatory terms, unallocated activity can behave like a big web of short-term liabilities and derivative-style exposures. When NSFR penalizes certain balance sheet profiles, the easiest response is not to ban gold. The easiest response is to make unallocated intermediation more expensive, shrink limits, widen spreads, and push clients toward structures that consume less balance sheet. Let me make unallocated crystal clear with a simple example. Imagine 10 clients buy gold exposure through a bank. Some buy, some sell, some hedge, some roll. In the unallocated system, the bank can net these flows internally. Client A is long 1,000 ounces. Client B is short 800. Client C is long 500, and so on. On paper, the gross numbers look huge, but the bank only has to manage the net difference. That's why unallocated became the beating heart of the London market. It allows enormous turnover with a relatively efficient use of actual physical movement, and it keeps the system liquid. Now picture what Basel III does to that model. If regulators treat parts of that activity as needing stable funding, the bank can't just run it on thin, short-term money. The netting magic still works, but the balance sheet cost rises. And when balance sheet cost rises, two things happen immediately. The bank either widens spreads and charges more to carry the exposure, or it reduces the size it's willing to intermediate. Either way, liquidity gets thinner. Thin liquidity is what turns normal moves into violent moves because there's less depth to absorb a rush of orders. This is also why you can see a weird pattern in stress. Paper price can drop fast because paper liquidity is the first thing to evaporate, while physical demand can rise because fear makes people want the real thing. That divergence is not a conspiracy. It's what happens when promises are easy to sell and hard assets are hard to source. That's why people call this a trap, not because someone is secretly plotting in a room. The trap is mechanical. It's math. If regulators make paper gold more expensive to intermediate, banks will either pass the cost to clients through wider spreads and higher financing charges, or they will reduce the service. And if enough banks reduce the service at the same time, liquidity dries up. When liquidity dries up, the paper price becomes jumpier, the basis between paper and physical widens, and the market starts behaving like a stressed system instead of a smooth market. So why does this kill paper gold? 3 reasons. And I want you to feel these like physics, not opinions. First, NSFR attacks leverage. The paper gold ecosystem is built on leverage because the whole point of paper is efficiency. Tiny funding cost, huge notional turnover. Basel III says, if you want to run that machine on a bank balance sheet, you need stable funding behind it. Stable funding is not free. That's like turning a sports car into a truck. It still drives, but the acceleration is gone. Liquidity is the acceleration. Second, NSFR attacks maturity mismatch. A lot of paper gold activity is short-term funding against longer-dated exposures rolled again and again. In calm markets, that's normal. In stress, that's a death spiral. Basel III is designed to stop death spirals. The side effect is that it reduces the ability to warehouse large paper positions cheaply, which means the market can't absorb shocks the way it used to. Third, Basel III changes incentives inside the bank. Banks don't have one goal. They have 2: make money and survive regulators. In the old world, a desk could run a giant book because the funding looked cheap and the risk looked manageable. In the Basel III world, the same book can suddenly consume balance sheet capacity like oxygen. And when balance sheet is scarce, it gets allocated to the highest return per unit of regulatory cost. That's why some activities get deprioritized, not because they're evil, because the internal economics changed. Here's an analogy that makes it click. Imagine a busy highway where everyone drives fast because tolls are near zero. That's paper gold, low friction. Now the government quietly raises the toll 10x, but only on the biggest trucks. Those trucks are the banks. Do the trucks keep driving the same routes? No. They either raise delivery prices, take fewer trips, or avoid the route entirely. The highway gets quieter. And when an accident happens, there's no spare capacity to absorb the shock. One crash turns into a pileup. Now let's talk receipts, because this is where people either get it or they don't. Receipt number 1 is the NSFR treatment itself. Traded commodities, including gold, tied to a high stable funding requirement. That is the why now behind the conversation. Receipt number 2 is how the industry frames the issue. The London Bullion Market Association has written publicly about how Basel III touches precious metals market structure, highlighting NSFR and also pointing out key regulatory classifications, including that gold is not treated as high-quality liquid assets under the liquidity coverage ratio, and describing technical factors like interdependent assets and liabilities. The details can get nerdy, but the takeaway is simple. These rules shape how much balance sheet banks can dedicate to making paper gold liquid. And here's the part retail usually misses. None of this requires a ban. Markets can break without bans. All you need is for the market makers to step back 1 inch at the same time. In paper gold, that inch is huge because the market has historically relied on banks to, quote, tight spreads, warehouse risk, and provide leverage. Basel III doesn't have to end paper gold. It just has to make it less elastic. Less elastic markets move harder. Now, if you're watching from Pakistan, the Gulf, the UK, Canada, the US, this still matters to you because global prices are set at the margin. The marginal price in gold is often discovered in paper venues first. If paper liquidity changes, your local physical market feels it through spreads, premiums, delivery times, and hedging costs. A jeweler in Karachi doesn't need to read Basel III to feel it. They feel it when hedges cost more, quotes get wider, and inventory becomes available next week instead of available now. So why are we seeing this discussion come back again and again? Because paper gold's biggest strength, its ability to create huge liquidity with minimal friction, becomes a weakness when regulation hits the intermediaries. And when something is structurally changing, the market tends to do the same thing it always does. It waits until the last moment, then it moves violently. Let me give you two past cases so you understand the pattern. In 2008, the lesson wasn't prices went down. The lesson was, when the plumbing breaks, the screen price becomes less relevant than real-world access to the asset. Gold had moments of forced liquidation, yes, but it also had moments where distrust in counterparties created a powerful bid. People learned the difference between I own a thing and I own a promise. Then in March 2020, you saw a modern example of a split. Markets were selling everything for cash. Gold got hit in the initial liquidation, but at the same time, the physical market saw frictions: logistics, refining, transport, and regional premiums, and paper-physical relationships got stressed. The world learned again. Liquidity events can smash the paper price first, even if the long-term demand for a hedge asset is rising. Basel III matters because it changes the ability of the system to paper over those stress moments. If the dealers can't expand balance sheet as easily, the gap between paper and physical can widen faster and stay wider longer. That's not a prediction. That's what happens in any market where market makers become balance sheet constrained. Now let's connect this to the question everyone actually cares about. What happens next? There are three scenarios, and I'm going to give you what invalidates each, because that's how you avoid delusion. Scenario 1, the slow squeeze. Under this scenario, Basel III gradually reduces paper gold liquidity. Spreads in OTC forwards get wider. Hedging becomes more expensive. Some flows migrate from unallocated to allocated. Premiums for physical, especially in regions with strong retail demand, trend higher relative to spot. The paper price still moves, but it becomes more jumpy, with sharper intraday spikes and drops because depth is thinner. This is not a single crash, it's a regime change. What would invalidate this? If banks and market infrastructure adapt in a way that restores liquidity without expanding balance sheet, better netting, better clearing efficiency, more internal compression, or non-bank intermediaries stepping in at scale. If the market finds a new equilibrium where liquidity is similar and spreads normalize, the slow squeeze becomes just a story, not a reality. Scenario 2, the volatility shock. Under this scenario, there is a catalyst. Maybe macro panic, maybe geopolitical escalation, maybe a sudden rush into allocated metal that collides with thinner paper liquidity. The result is a violent disconnect. Paper price gaps, liquidity vanishes, and you see a move that feels like it came from nowhere. In this scenario, the paper gold market doesn't die, but it loses credibility for a period. And credibility is everything in a market built on promises. What would invalidate this? If physical premiums remain calm and the basis stays tight even during stress. If the physical market absorbs demand without strain, then paper volatility is just paper volatility. The scary version requires physical tightness plus paper dysfunction. Scenario 3, the policy backstop. Under this scenario, regulators and central banks become sensitive to market functioning. If a market that supports hedging and global trade starts to seize, policies can be adjusted or timelines can be softened. The world is full of rules until they cause a crisis. Under this scenario, Basel III still tightens things, but the sharpest edges are managed to prevent systemic disruption. What would invalidate this? If stress hits and there is no response, no flexibility, no accommodation, no temporary relief, and banks are forced to shrink activity aggressively regardless of market chaos, that's when the hard reset narrative becomes more plausible. Now I know what you're thinking. Okay, but is this good for gold price or bad? The honest answer is, it depends on your time frame and what you mean by price. In the short term, any rule-driven squeeze in leverage can cause liquidation. When leverage gets expensive, players de-risk. De-risking can push the paper price down temporarily. That's the paradox. A structural change that can be bullish for physical scarcity can still produce a bearish paper move first, because paper positions unwind quickly while physical doesn't magically appear. In the medium to long term, if the system carries fewer paper claims per real ounce, if the market shifts toward more stable funding, less synthetic supply, and more emphasis on direct ownership, then the price discovery process can become more anchored to physical reality. And historically, assets that cannot be printed tend to do well when the world realizes printing has limits. But I'm not here to sell you a fairy tale. I'm here to tell you what to watch. Here are the metrics that matter, and I want you to treat them like warning lights on a dashboard. Watch the spread between spot and physical premiums in your region. If spot is calm but premiums rise, that's the physical market telling you the screen is underpricing access. Watch borrowing and leasing conditions. When the cost to borrow gold rises unusually, it's a signal that balance sheet and availability are tightening. It doesn't guarantee price direction tomorrow, but it tells you about stress. Watch how bullion banks talk about client flows. When banks start nudging clients toward allocated structures, it's usually not because they suddenly love safety. It's because regulation makes the old structure expensive. Watch delivery and settlement friction. In a healthy market, you can source metal and settle within normal timelines. In a stressed market, the same transaction becomes back-ordered, allocated later, settle in cash, roll the contract, sorry, not available. Those phrases are more informative than the spot price. Now I want to address the trap that crushes retail investors. When people hear Basel III kills paper gold, they emotionally jump to extremes. So paper gold will go to zero. So banks will default tomorrow. So I should do something reckless. No. That's how you become exit liquidity. Basel III is a structural force, not a magic switch. Markets adapt, banks reprice, flows migrate. The danger is not that the world ends overnight. The danger is that the plumbing becomes less forgiving. So when the next stress event hits, moves are sharper and the average person is forced into the worst possible decision at the worst possible time. So what do you do practically? First, know what you actually own. Allocated metal is metal. An unallocated claim is a promise. An ETF is a structure. Sometimes a strong one, sometimes one that can trade at discounts or premiums under stress. Read the product documents, know how redemption works, and whether you can take delivery. Second, size for survival. If you are trading leverage, futures, options, leverage products, Basel III is a reminder that rule changes can move markets faster than your brain can adjust. Never be in a position where one policy change can wipe you out. Third, separate trading from protecting. If your goal is protection against currency risk, geopolitical risk, and systemic risk, don't mix it with a short-term leveraged bet. Protection is boring by design. It's insurance. If you treat insurance like a slot machine, you lose the insurance. Fourth, build a watch list, not just gold price. Build a watch list of signals, funding stress, premium stress, volatility stress, and policy stress. Because the first sign of trouble rarely appears in the headline price. It appears in the plumbing. And now zoom out, because this is the real message. Basel III is not about gold. Basel III is about trust. After 2008, the world decided the banking system was too fragile, so regulators built rules to force stability. That stability comes at a cost: less leverage, less free liquidity, fewer games built on thin funding. When that cost hits a market that has relied on thin funding like paper gold, the market has to change. And whenever a market changes, wealth moves, not from rich to poor, from impatient to patient, from leverage to liquid, from people who react to people who prepare. There are three types of viewers watching this right now. The first type is panicking. They hear new rules and trap, and they want an instant trade. They want a dopamine button. That person usually gets chopped up. The second type is dismissive. They think regulation doesn't matter until it shows up in a headline. They will be late. The third type is curious and disciplined. They want to understand the mechanism, watch the signals, and make decisions that still make sense even if the market moves against them first. Be the third type. And remember this: charts don't veto regulation. A perfect technical setup can fail the moment funding rules change. Basel doesn't care about support levels. It cares about stable funding, capital, and liquidity. When those constraints tighten, the market can gap right through your levels without permission. One final thing: nothing in this video is financial advice. I'm not telling you to buy or sell anything. I'm giving you a framework to understand a real structural change so you can think clearly instead of emotionally. Now I want you to do something for me. Comment one word: paper. If you think paper markets keep control of price discovery, or physical if you think the next decade forces a repricing toward real metal. And if you want the next video, I'll break down the specific indicators that show when a paper market is losing credibility before the headlines admit it.